Have you ever dreamed of growing your wealth and achieving financial freedom, but felt overwhelmed by the stock market? You're not alone. Many people feel the same way. But what if I told you that investing in the stock market doesn't have to be as complicated or intimidating as it seems? Welcome to today's video, where we'll break down the basics of the stock market and show you how to take your first steps toward investing. Whether you're a beginner or someone looking to better understand how the stock market works, you're in the right place. Before we dive deep, do me a quick favor. If you find this content helpful, hit that subscribe button and let's get to 1,000 subscribers. Your support means everything, and it's a huge motivation for me to keep bringing you useful content like this. What is the stock market? To understand how to get started in the stock market, we first need to answer a basic question. What is the stock market? At its core, the stock market is a place where people buy and sell shares of publicly listed companies. Think of it as a giant marketplace where investors trade pieces of companies. When you buy a share, you're essentially purchasing a small ownership stake in that company. Now, why should you care about the stock market? Well, investing in stocks gives you an opportunity to build wealth over time. It allows you to participate in the growth of companies and benefit from their success. Over the long term, the stock market has historically provided a higher return compared to traditional savings accounts or other forms of investment. How the stock market works. Now, let's talk about how the stock market actually works. There are two main ways people invest in the stock market: directly by purchasing individual stocks, or indirectly through mutual funds, exchange-traded funds, ETFs, or index funds. When you buy a stock, you are purchasing a share of that company. But here's the thing: companies don't sell stocks just for fun. They sell stocks to raise capital, which they use for expansion, research, or paying off debts. And here's where it gets interesting. When these companies grow and perform well, your investment grows too. However, it's important to note that stock prices can go up and down based on the company's performance and broader market conditions. One key point: the stock market isn't a get-rich-quick scheme. It requires patience, strategy, and of course, some research. But if you stay consistent and invest wisely, the returns can be rewarding over time. Setting your investment goals. Before diving into buying stocks, it's important to set clear investment goals. Are you looking for short-term gains, or are you planning for long-term growth, like retirement? Your goals will influence the types of investments you make. For example, if you're looking for long-term growth, you might focus on blue-chip stocks or index funds that track the broader market. Setting goals also involves understanding your risk tolerance. Are you comfortable with the ups and downs of the market, or would you prefer a more stable investment? Your risk tolerance will guide your decisions when picking stocks or funds to invest in. Types of investments. Let's quickly go over the different types of investments available in the stock market. First up, individual stocks. When you buy individual stocks, you're investing directly in specific companies. This could mean buying shares of well-known companies like Apple, Amazon, or Tesla. However, keep in mind that individual stocks carry more risk since their performance is tied to the company's success or failure. Next, we have ETFs and mutual funds. These are bundles of stocks, often tracking specific industries or markets. ETFs are popular because they are traded like stocks and offer diversification, meaning you're not putting all your eggs in one basket. Mutual funds, on the other hand, pool money from many investors to buy a wide variety of stocks. These are typically managed by professional fund managers. Finally, index funds. These are like ETFs in that they track specific indices, such as the S&P 500, but unlike ETFs, they are not traded throughout the day. Index funds aim to replicate the performance of the market or a segment of it. Many investors prefer index funds due to their low costs and solid long-term performance. How to buy stocks. Now that you understand the different types of investments, let's talk about how to actually buy stocks. The first step is to open a brokerage account. There are many online brokers, such as E-Trade, Charles Schwab, and Robinhood, where you can open an account and start trading. When choosing a broker, consider things like fees, ease of use, and the range of investment options available. Most brokers also offer educational resources and tools to help you make informed decisions. Once your account is set up, you can start buying stocks. You'll select the stocks or funds you want to invest in and place an order. It's important to note that there are two main types of orders: market orders and limit orders. A market order is when you buy a stock at its current price, while a limit order is when you specify the price you're willing to pay, and the trade will only go through if that price is met. Building a diversified portfolio. One of the most important principles in investing is diversification. This means spreading your investments across different types of stocks or funds to reduce risk. The idea is that not all of your investments will perform poorly at the same time. So, while some of your stocks might not do well, others may thrive. A diversified portfolio could include a mix of large-cap stocks, small-cap stocks, bonds, and international funds. It's about balancing risk and reward based on your goals and risk tolerance. Risk and reward in the stock market. Let's talk about risk. All investments come with some degree of risk, and the stock market is no different. Stock prices can fluctuate daily, and there's always the possibility of losing money. But here's the thing: the higher the potential reward, the higher the risk. Over time, however, the stock market tends to reward those who remain patient and invest for the long term. One way to manage risk is by being well-informed and sticking to your investment strategy. Don't make decisions based on short-term market movements or panic when the market dips. Staying the course and investing regularly through things like dollar-cost averaging can help smooth out those fluctuations. The power of compound interest. One of the most powerful concepts in investing is compound interest. This is where your earnings generate even more earnings. For example, if you invest in a stock and earn dividends or interest, and then reinvest that income, you can earn returns on your initial investment and on the returns you've already received. Over time, this can lead to exponential growth of your wealth. The earlier you start investing, the more time compound interest has to work in your favor. All right, we've covered a lot today, from understanding what the stock market is to the types of investments available and how to get started. But the most important thing is that you start. The stock market can be a great way to build wealth, but it requires patience, strategy, and ongoing learning. Remember, don't be discouraged if it feels confusing at first. Everyone starts somewhere. And always remember, investing isn't a race. It's about being consistent, learning as you go, and letting time work in your favor. Before I sign off, don't forget to subscribe to my channel if you found this helpful. Let's reach 1,000 subscribers together. Your support means a lot. Thanks for tuning in, and happy investing.